Hello and welcome to Portfolio Matters. In today's share talk, we will be discussing Altus Strategies, which is a small UK listed mining royalty company / explorer with an African focus. But before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Okay, Altus Strategies. Now, this is going to be the third mining royalty company we have covered. So Richard alerted me to mining royalty companies with his presentation on Ely Gold. And this is the performance of the Canadian gold mining royalty companies, and the performance has been absolutely extraordinary. So I've then been on the lookout for London listed mining royalty companies, and this is the second one we'll be covering. The first one was Anglo Pacific Group, and I urge you all to have a look at the share talk on that. Altus Strategies is much smaller. Okay, so what it does is it explores Africa for mining assets and then forms joint ventures to develop them. It takes some royalty as the mine is developed, and when the mine is fully developed, it retains a royalty in the mine, a net smelter royalty or a gross revenue royalty. This is the share price. The share price over the last couple of years has been incredibly strong. It's up fivefold, which is a problem. Okay, so share price is currently about 85p, market cap 60 million sterling, has net cash of 6.7 million, and it's got tiny revenues. The forecast revenue, according to Stockopedia, is 290k. Okay, and the summary is going to be, I really like this company, that I like the shareholder-friendly management. I emailed the CEO and got a reply in a day with highly detailed information describing exactly how to value the Tabakorole development. And that was incredibly helpful, and I really appreciated it. So I really like the management. But the bottom line is the shares are up over fivefold in 2 years and now appear fully valued. So there's got a lot of development assets which frankly are just impossible to value because you don't know how they're going to form joint ventures, how much those joint ventures are going to be worth. And in coming to a conclusion on this company, I had to rely on the SP Angel, who are the tame broker employed by Altus Strategies, and their valuation note, which values the company at 100p NAV. So I actually have bought some of this, but I bought some of it to tuck away for a very long-term view. And at the current share price, I think you would say it's fully valued. Okay, so what's the business model? Well, it's Africa focused and it's gold focused. Now, when you listen to the CEO, and there are a lot of interviews online of him talking about the company, the reason they focus on Africa is because it's relatively underexplored. The average depth of a new mine find in Africa is about 8 meters. So what that means is 9 out of 10 of the finds are on the surface, and there's one of the finds is down 200 meters or 100 meters, whereas the average find around the rest of the world is at 200-meter depth, i.e. all the surface discoveries have been made. So that's why they're focusing on Africa. So what it does is it explores, it finds assets, and then it forms a joint venture which is asset specific. So for that particular discovery, Altus will have formed a company which they then have a joint venture with a mine developer. And as the mine is developed, Altus benefit from milestone payments. And ultimately, when the mine is developed, they get a net smelter royalty or a gross revenue royalty. And in February 2020, they got a big vote of confidence when the African-focused mining investment company La Mancha took a 35% stake for £6.5 million. But frankly, the shares are now 3 times higher than that. Okay, so a couple of mining terms we're going to need. Indicated resources. The indicated resources are economic. They're economic to extract now, and you have a high level of confidence that they are there. The inferred resources can be inferred from exploratory drilling, but are much less certain. So indicated is much better than inferred. And this is the business model. So what Altus do is they go exploring, they find a gold deposit that boosts value, but they then need to develop it. And at that point, they have to get in a mine development company, an established gold miner, and they have to give away quite a lot of value to get it built. And then finally, once it is built, they get royalty payments. And this, as we've discussed before, is the value valley. And this takes a long time to go from discovery to development. And during that time, you have to pay out and you're giving away value to your partner. So these are some of the discoveries they have. And this is the structure. So Altus forms individual companies which own the discovery, and they then form a joint venture. So down here we have a joint venture with Resolute and with Canyon Resources to develop the mine. And these are the projects and the discoveries, and you see they're steadily growing, but they have relatively few joint ventures currently. So there's a lot in the pipeline that they are firming up the discovery, and then they need to form a joint venture. And then years in the future, when the mine is developed, they'll make some money out of it. The thing about Altus is it is very well diversified. They're looking at a lot of discoveries, whereas most royalty companies, they are buying into discoveries and helping with the development of the discovery. Altus are discovering it and then trying to get it developed. So it's a different business model, and they've got a broad range of discoveries, but 70% gold. And this is the portfolio project pyramid. And you can see there are a few at the top where they're exit and monetization, but they've got a lot coming up. And these are the ones where they have formed joint ventures. The big ones, the ones that matter, are Lecanfla and Tabakorole, which are in Mali with Marvel Gold. But there are others where they have formed a joint venture and they're doing the exploratory drilling, and that if all goes well, those will become valuable. But right now, they're not really valuable. They're more speculative assets. Now, only 3 projects matter, according to SP Angel. Diba is their most valuable project, and they have currently 100% of that, and they have not yet formed a joint venture. In the valuation, the NAV calculation by SP Angel, Diba is worth 50p a share and is by far the most valuable asset. The other 2 that are important are Lecanfla and Tabakorole, and we will go into the value of those projects, and Tabakorole in particular, to the company. So this is how it works. The scale on the left here is meters drilled, but you see how, you know, they're just constantly drilling and trying to find new assets. These are the assets they have and the stage they're at. So DEBA is progressing towards drilling and then resource definition, essentially. The Cantler's got lots of drilling, Tabakorole's got lots of drilling, and then they've got these new sites, licenses in Egypt, where they will be trying to work out what they've got. They'll be actually examining land and seeing if there's anything on their license area. So they've got a lot on their plate. There are a lot of targets. This is 2021 announcement that they have licenses in the Nubian Shield in Egypt, and Centamin, which is a company that we have previously covered, is up here, and that produces 500,000 ounces per annum. Well, it does in a good year. And Altus have a license down here. Okay, so this is very difficult to value, and it's got a lot of early stage assets. So in order to value it, I've looked at the SP Angel valuation. Now, bear in mind, this is paid research by the company and should be treated with caution. But the bottom line is they valued the company at 100p a share. Now, the share price is currently 84p. And to me, that's fair value. There's not much upside. And the NAV calculation should be treated with caution because it's paid research by the house broker. But their valuation is dominated by DEBA and Tabakorole, which there's a joint venture with Marble Gold for Tabakorole and Lecanfla. Okay, so the DEBA, they are saying that is very valuable, 81 million pre-tax, NPV 10, you know, etc., etc. But the reality is they have not yet got a joint venture partner. And since this note was put out, they've made a new discovery at DEBA Northwest that adds resource. So that would be upside. And you can see that Altus have a lot of licenses in Mali, and they've made a lot of discoveries. So there's DEBA here, there's Lecanfla, there's Tabakorole, there's Pitian Goma. And this is a subset of the graph showing you that all these things are quite close together in the gold belt. And this is the gold project, DEBA, where they've got indicated resources of 217,000 and inferred of a further 187,000. So potentially very valuable, and it will be an open pit. And they have 7 targets within 7 kilometers. So there's potential a lot of upside. And since this chart was this presentation, they've found gold, you know, in the northwest, 1.5 kilometers away. Okay, but Tabakorole is subject to a joint venture with Marble Gold, and Marble Gold currently have 51%. Now, I found it quite difficult to work out what the economics were for Altus. So I emailed this chief executive, Steve Poulton, and he very kindly sent me a page-long email detailing the royalty terms within the day. And I was very, very impressed. So thank you for that. Right, so the details are: Marble Gold are required to invest a further 3 million in direct exploration and then make a milestone payment of $100,000 to Altus, and that will take their holding to 70%. So that increase in the holding for Marble Gold is dependent on them basically spending more on the development of the mine, but Altus will only get 100K. To increase their stakeholding further to 80%, Marvel have to undertake a feasibility and development study and make a further 150 grand payment to Altus. At that point, Marvel will own 80% of the mine, and Altus then have a decision to make. They can either then participate in the mine development, in which case they will have to fund 20% of the development cost, as they will be 20% owners, or they can elect for Marvel to fully develop the mine at their cost, at which point Marvel will pay Altus $1 million, but will then have 100%. So there are two joint ventures with the same terms, one for Tabakorole and one for learnng. Altus retains a 2.5% net smelter royalty. However, Marvel can repurchase the net smelter royalty at a rate of $3.33 million per 0.5% for the first 1.5%. They have no option over the last 1%. Okay, currently the resource at Tabakorole is estimated to be 1.5 million ounces. Okay, so if you have 1% of a million ounces times $1,700 an ounce, that would equate as net smelter royalty to Altus of $17 million. Now, if you add this all up, so we assume that Altus do not take part in 20% development of the mine. Instead, they take $1 million, and that Marvel repurchase the first 1.5% of the net smelter royalty at a cost of $10 million, then in total, Altus would make $13 million from the development of this 1.5 million ounce resource, which is worth a lot of money. So the bottom line is that a lot of these deals were done quite a long time ago, before the gold price had shot up. And I really wonder about whether they would now sign these options allowing Marvel Gold to buy back the net smelter royalties for only 1.5% for $10 million. It seems very low. And these agreements would obviously be very meaningful for a company which had a market cap of 12 million quid, which it did up until 3 years ago. And now when the market cap is 60 million, that is, they're much less meaningful. So frankly, I think this company is rather fully valued currently based on the projects they have formed joint ventures for. Hypothetical assumption that Tabakorole has a 1 million ounce life of mine, and the JORC is currently 910,000, but obviously that's increasing as they explore it further, and that would be worth 1.5 billion at $1,700 an ounce. So a $1.5 billion mine, and Altus make 30 million. Obviously they don't have to develop it, but those are quite low numbers, frankly. Same again for learnng, and these are the joint ventures, the net smelter royalties. But the thing is, if they've signed these options to buy back some of the smelter royalties, you don't receive the full amount of that if the gold price goes above the levels you've assumed. So, and these are the results, and as you can see, revenues are very low. I mean, this is a company with a lot of potential in the future, but right now, it's small and loss-making. So positives, really like the management. Thank you to Mr. Steve Poulton for answering my emails so promptly. It's La Mancha obviously believe in them, and they have invested 6.5 million about a year ago, but they did so at a price where the price has since trebled. And it's a history of successful exploration, and it continues in that. So, all those exploration assets could well become development assets, in which point it starts to make some money. But right now, as we've seen, it doesn't make any money. And if the commodity super cycle continues, then Altus is well placed. However, it's loss-making. It's loss-making for the foreseeable future. The valuation is heavily dependent on DEBA and the creation of a successful joint venture, and we just don't know what terms that joint venture will be done on, or if one will be done at all. It's heavily exposed to gold, and the gold price is drifting off. The shares are up fivefold in the past 2 years, and as we have discussed, I think this company is probably fully valued, with the share price approaching the NAV of estimate of SP Angel of £1. And, frankly, I think that the economics of the Tabakorole development for Altus are rather disappointing. A 1.5 billion resource, and Altus stand to make $30 million. You need to develop a hell of a lot of $1.5 billion mines to make any money, frankly, because that 30 million is not up front. That is over years. That's over the life of the mine. And early stage projects are very difficult to value. And frankly, this valuation is dependent on SP Angel. And a lot of those joint ventures are in the books at, not very much. So if you believe that the stream of exploration assets can be turned into good development assets, and then Altus will eventually get a royalty revenue stream from those mines, this could be long-term value. And if we look at the performance of mining royalty companies, they often follow this trajectory of shooting up in the first couple of years and then grinding steadily higher in subsequent years. But those those royalty companies generally are buying royalties in mines that are being developed. This Altus does earlier stage stuff, and so there's likely to be a longer lag between discovery and Altus finally getting some money. So in summary, I like this company, but I think it's fully valued, and I bought a bit and I'll see how it goes. But this is one to hold for the very long term. Richard, any thoughts?
Thank you very much for that very interesting presentation, Keith. It strikes me that this company is bootstrapping itself. It has it's highly capital constrained. Only has 6 million of cash, and what it's doing is it's saying any return is better than no return, because any return I can reinvest at a much higher return. So it's sort of sold its early years royalties in order to have a bit of extra cash, so it can invest in a better royalty that will give it a bit more of a return, and it's sort of trying to work its way up this sort of exponential curve.
Yeah.
And so I understand its business model, but of course it has the consequence of exactly what you say. It basically means it's not getting a sort of fair chunk for its efforts of the resources that it's finding. So I think it needs to do two things. It needs to raise capital and then own more of the assets that it finds as part of its exploration, and then to be able to stick in there for longer. Yeah. So it needs to do that. And the second thing is that clearly there would appear to be massive potential in terms of the exploration in the area where it's operating, and it will continue to take advantage of that. So long term, it could actually, as you suggest, become very valuable. At the moment, it's bootstrapping itself, and I think it should use its market cap now, its fivefold share price increase, to raise a significant chunk of money.
Yeah, absolutely. So I think this is one really to watch. Yeah. I've got a tiny position, and the shares are incredibly liquid, by the way. Yeah. But one for the long term, and we will continue to update it as things develop.
Well, thank you very much for the hard work and effort you put into a very interesting presentation, Keith.
You're very welcome. And I will be looking over the next couple of months at the two other mining royalty companies I found listed in London, which are Trident Royalties and Metal Tiger.
Good. And can I just make a request, please, of people? If you have anything you'd like to add to this presentation, then we'd be very happy to receive your feedback. And we love getting constructive feedback that gives us more information than we have previously had. Please don't just tell us you don't like it without explaining what you think the problem is with it, because that way we have more information and we can give our viewers more information. Thank you.
Absolutely. Well, thank you, Richard. I hope everyone enjoyed that. Please, can you press like and subscribe to our channel? And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.